folks. Welcome to this symposium on the 20th of January 2025. Okay, so I posted this, a couple of days ago while on holiday, and this was based on a bit of a study that I'm doing currently about randomness, entropy, and things related. Essentially, you have something like a random system, and a random system can be noise or movements of air or movements in water or movements of particles on the surface of water, or that are suspended in gas, how particles kind of bump into each other. They kind of bump into each other. Boom. I mean, what happens to them? Well, this one gets thrown, depending on the angle, this way. And then this one, once it hits it gets thrown maybe in this direction. And then there's another one here. And when this one reaches this one right there, maybe it bumps into that one and sends this one in this direction. Okay, so this is a truly random system. Okay, and a lot of the stuff that I used to speak a lot with my mentor about is this whole concept of fractals, where you have a pattern. It can be a pattern that looks like, or in the context of trading, where you have, let's find one here, where you have something like this. Prices go down, then up, they visit the highs, they go through, and then they go up. Okay, this is a pattern that is observable on this time frame. But you can also take this pattern and you can look inside maybe the wick of this candle right here. And the amazing thing about that is, inside this little tiny wick just here, this whole exact same pattern is observable. Okay, and then you think, gosh, well, that's amazing. Or then you take this whole structure of price that you can see right here, you look at it, and you look on a macro scale, and you realize that this whole structure right here is actually right here. This is what it looks like right there, in that little price swing right there. Okay, then you think, gosh, that's amazing. And then you can keep going, you can keep zooming into here, and you'll see that, which will resemble that, which will resemble that, maybe. And it goes on and on and on. And if you continue to zoom, you continue to see the same patterns emerging despite the scale of the data that you're looking at. Okay, so this is what Chris would always talk about. If something is fractal, you have those those Mandelbrot algorithms where you can keep zooming in, and you go to like the shoreline of a fractal pattern, and you zoom in, and the same patterns continue to emerge, and it's this whole recursive function where you just zoom in, and while everything changes, the same overall structure of the pattern resembles the other patterns that you've seen historically, both on a macro but also a micro scale. Okay, but it's completely random. And so I wanted to test this hypothesis. So I made a super simple piece of software that focuses a little bit on this. And if you look at this, this looks like perfect price action. We have the buy zone, we go deeper, we move higher, we come down, we test a little price structure here, we move through it, we visit that price point right there. Okay, we do not manage to move through it until here, so you go back to the source, which is just here. We test it, we move into it, we move above. What area of demand is responsible for taking out this high? Well, there's something in here. You can see the candle move in the opposite direction, like that. Tested. Now it's gone. What area did it? Here's a candle that moved in the opposite direction. We tested it right there. It's gone. Where's the origin of this move? It's down here in the base somewhere. Prices come pretty close. And so looking at this, this looks like completely normal quote-unquote predictable price action, where we have liquidity exploration patterns, where you have lows and prices seeking bids below those lows. We have demand. We have demand here being tested and then consumed, and later seeing respect for the zone that consumed the opposing zone. Okay, again we have demand, removing these highs here, tested, pancakes, going deeper, finding that bigger pancake to satisfy the hungry eaters, which sends people higher. Okay, you take out highs. What does that mean? It means we create new patterns. Demand, tested, consumed, tested. Okay, this, I don't think anyone can disagree when I say, is a completely normal, predictable behavior of price. Okay, that we see over and over again. When I go through the charts on the videos, I mean, everything looks like this. But what I want to bring your attention to is this. Okay, this is a little tool I made that automated some of these processes and concepts that I wanted to test. Okay, and so I wanted to make it look like price as much as possible. So I have a number of bars to generate slippage, volatility, trend, and the trend just means if it's zero, it's going to be. There's going to be no weighting to the price. If it's positive, there's going to be weighting to the price, a positive weighting, which means it's probably going to flow higher. If it's negative, it's going to add a negative weighting, which is going to result in prices moving lower. So this is just a way for prices to encourage the data to be skewed either to a higher tendency or to a lower tendency. But if I leave it on zero, it should be relatively flat. But when I click on this button, what happens? Well, what happens is I use a random number generator to generate the open, high, lows, close prices of candles. Okay, so when I click on this button, it generates data that looks like this. When we look at it, yeah, it looks like price data. But the insane thing about this is it is completely random. Completely random. And I'll do it again. Go. Random. This is random numbers being used to generate this stuff. Random. I can make the slippage bigger. That's very big. Let's put it to 0.08. Then there's going to be kind of a disconnect. Let's make it a little bit bigger because I've modified these quite a bit. And so here, there's going to be a slight disconnect. You can see that there's a slight disconnect between the closes and the opens. So you'll see this typically in slightly illiquid prices, or markets rather. And if we do like a pretty high liquid slippage, we're going to see that prices disconnect a little bit. You can see here, if we go all the way up here, it's a pretty high degree of slippage in the data, meaning that there's not going to be perfect alignment because we're not going to have a completely perfectly efficient market where there's no slippage. There's always a tiny bit of slippage. But on this one here, you can see that it's complete alignment between the open and the closed prices. And if I turn this down a bit, let's say to 100, so we can really take a look at these bars, you can see that they're absolutely perfect. They're absolutely perfect alignment. If we turn this up a little bit, we can see here that there's going to be disconnect. See, it's not perfect, which it rarely is. Okay, let's just put on default 0.03 or whatever. Then I have volatility, which is just a modifier. It's just a value that, if we put it on here, this is like a relatively low modifier. If we turn it up a little bit, it's going to cause prices to be slightly more volatile, as you can see here. But the point I'm making is, when we look at this, it looks like a completely normal behaving piece of price action. We've got supply here, it's tested. We've got a buy zone right in here. It's been tested, it's been removed. The origin of that is right here. What happens? Prices come to it once, twice, 3 times. Then it goes down. Okay, we have some supply here that's been tested. Here's the demand right there. It's been tested, respected. Prices move through it. The origin of the price that did it, let's take it from here. This is where prices go to. Here we have more. We have this tested, We have this. This is the kind of the origin. Prices go up. We have a sell candle. Prices rally, accumulate, rally. This is where we test. But the crazy thing about this is that this is completely random data. Completely random data. I'll do it again, and we'll look at it. Does that look like normal price data? It does. I'll do it again. Normal price data? Yeah, pretty much. Let's turn the volatility down a little bit. We'll do it again. What about this? Does this look normal? It does. It looks very normal. Here we have a high resistance. We're violated by this. Here's a zone that did it. Prices test that. We move higher. We have another high that's removed by something down here. Prices come down and test it. We have a little micro accumulation pattern, continuation pattern. Prices come down and test it. But it's all based on completely random numbers. But it still resembles price data. Okay, and so I went on a bit of a exploration to see what this is all about, and apparently this whole concept is called Brownian motion. Brownian motion, which I know absolutely nothing about. Well, a tiny bit now. Brownian motion, which is essentially referred to as a random walk. Random walk. And it was discovered by a botanist named Robert Brown, hence the name Brownian motion. And he observed this pattern emerging in particles of pollen that was suspended in a gas or a liquid. So if you have a little particle here, and this is suspended in some kind of a gas, you have another one here, and these are moving towards each other. When they hit each other, this is going to result in this one going maybe up here, and this one being pushed over here, because they're going to be leaving the impact point. Okay, and maybe there's another one, another particle here, and another particle here, or maybe here. And what that does is, it sends these two particles, the point of impact, they're forced away from each other. And these two, maybe the top one here, this is the point of impact here, maybe it goes this way, and maybe this one goes this way. But as you can see, it's completely random. There is no way to predict where these particles are going to go, because their interaction with one another is unforeseeable. You can't predict it. Okay? But the whole concept of a random walk is that, particles, they move completely randomly to one another. And if you have a particle that's suspended in let's say, water, the movement of water, which is also random, the waves, whatever, it's going to constantly ensure that this particle is moving in unpredictable directions all the time, and it's not possible to know exactly where it's going to go. Okay, and it's continuous because water is always moving. As if the water is always moving, it's going to move the particles in directions that are not foreseeable. Okay, but the cool thing about this is, it can be applied in fields like physics, which I know absolutely nothing about, or it can be used in finance. And finance is an interesting one because you can use it to model stock prices and other financial markets like crypto or Forex or commodities or whatever you like. But you can also use it in other scientific fields like biology, again, which I know absolutely nothing about. But the thing I'm trying to get at is this concept here that defines how particles were observed by a botanist. Back in I think it was the early 1800s, the whole mathematical concept or underlying theory can be used to explain the movement of asset prices. And I think that is completely mind-blowing. And so what we can do here is, let's just take this data. I'm going to generate a ton of data. Let's say 5. That's not a lot. We'll take 1400 and I'm going to say go. It's going to take a little bit here. Okay, it didn't take that long. Now I'm going to download it. I'm going to try and plop it or put it here. I'm going to replace that one and I'm going to go to the forecaster and I want to try and predict, see if it can predict this unpredictable data. And I've been toying around with like looking at means and whatnot. I haven't used these yet, but because it's time series data, time series essentially means that you have a series of data that changes over time. Okay, so here we have the data values and here we have the time values. Okay, so this is the data and this is time. And so at T1 we can have a value that's here. Team 2, let's just go 1, 2, 3, 4, 5, 6, 7, 8. And this can be from 0 to n. Okay, 2, it can be a little bit higher. T3, a little bit higher. T4, it can be a lot lower. T5, a lot higher. T6, a little bit lower. Okay, and so this is essentially what time series data is. Just data that changes over time. Okay, which is what this is. These are the data values we have. We'll focus on these four: the open, high, low, close. And we have, this is the D, and the T is here. Okay, these are the timestamps for each data point. Okay, and so now we say we want to select the date column or the T column, which we have just here. The target to predict, we want to predict the close price, and which features or which data do we want to use to go inside, and rather which ones we want to use to help predict the close price. And then we have a number of epochs, which is essentially iterations. We want to try and predict, I mean this is a lot, let's just say we want to try and predict 10, and I'm going to use we'll try a couple of algos, recurring neural network, a long short-term memory, and let's just run those. It'll take a second to run. Now it's just grinding underneath, and now we're building this model, we're building this neural network, and we're sending these data points through the neural network. And we're doing this for each of these features. And so what we do is you typically in machine learning, or rather deep learning, you have something called you have your data. This is the data that we are looking at. So all of the data points are going to be inside this box, so to speak. And then you have something called like a learning set, which can be maybe 75% of the massive data. And then we have a test set, which is 25%. And so what we do here is we use 75% of the data available, and we use it to see if we can predict 25%, the values of which we already know. Okay, so that's what you have. You have your learning set, and then you have your test set. So you learn based on 75%, and you test it on the remaining 25%. And so here, let's see if it's still grinding. It's still grinding. So here, this is what we're doing. So inside the algo, it's using about a 75, 25, or 80%, 20% split in the data set, and it uses this to try and predict. So if we now look at this, I'm just going to go like this. Look at this. Okay, this is pretty remarkable because we're using two algorithms, GRU and RNN and LSTM, short-term memory. And this is the data that we know. And also here, let me zoom in even a little bit more. This is the data that we also know. So we're testing the solid line is data that is predicted against the data that we already know. And you can see, you can't really see it there, but here you can see it follows beautifully the contour of the data. So here, I mean, it went up, down, like that. You know, it does that. And all of these algorithms are capable of doing the exact same thing. And then we have the data set here. This is the predictions for the future. And based on its ability to predict, which we can see is pretty damn good, this is what it's going to try and predict for these future values. And note that this is all based on that number, that random data generation tool that I just showed. Okay, but what I'm trying to say is that you can use this to predict price data very efficiently. And if we change the data set and we just say, let's have a look at, I've got some stuff in here, download. I don't know what this is. Date, open. You want to predict. This is just an asset price, a real one. And we'll just use, let's just use GRU because it's quick. We'll run that and we'll let it crunch those numbers for us. That's too much. Let's do 5. Boom. I'll run it again. And we'll see what it does. Okay, wow, it's already done. So here, it did a pretty good job. You know, it moves a little bit relative to the data that we can see. And here it says that the next 5 days are probably going to be flat. Okay, and if we zoom in a little bit, you can see here that it did a pretty decent job at predicting that. You could see that there was kind of a plateau, you know, which we saw here. There was a plateau, price is sideways. Then it was a decline, an increase, and now it's looking flat, which is what it's telling us is probably going to happen. I don't even know what this is, but this is real price data. Okay, and so, yeah, this data is what I'm trying to say is using any number of these algorithms or others that I have not yet implemented can be used to help us predict future data prices, which I think is amazing. And keeping in mind that the data that we have follows some very, very predictable rules based on what we can see according to the Brownian motion, which is this random walk concept. I think that we could position ourselves to maybe do something that would be pretty remarkable. And moving on, taking this concept, the fact that we have completely random data, if we have even a slight edge that gives us a 40% hit rate, okay, which is not a lot, but it's enough, and we are able, out of this hit rate of 40%, we're able to ensure that we get an average risk reward of 1 to 2, so 2R, so 2 times the reward for each item or each amount risked. Okay, we're risking 0.25%. We have, let me show you something here. This is 100, so this is a super tiny sample size. Let's try something even smaller because this will make sense to you in a second. And we run that. You can see slightly skewed, 16% over 50 trades. That's all right. Go again, 21%, minus 10%, 30%, minus 6. But you can see there is a slight skew in the positive direction. But this is only 50 trades. If you take this and you say, okay, what about the possibility of 50 trades not being enough to see the certainty or see this probabilistic model playing out? Let's maybe add 50 more trades, and then we'll run that once again. Okay, what does it look like? 26%, 46%, 26%, 36%. Notice, have we seen any negative numbers yet? 70%, 1%, 21%, 8%, 57%, 90%, 8%, 4%, 21%, 12%, 41%, minus 6%. So I don't know how many we went. We meant maybe 15 simulations that were all incredibly positive. We only had one slightly negative performance just here. Okay? And this is 100 trades. Imagine for a second that you have, let's say you take one trade a day every year, and you do that over 10 years. And all of these parameters that you can see here are applicable or are valid. Okay, so we have 250, how much is it? 252 trading days a year. That's per year. Let's times that by 10. And now, this could be over the career of a 10-year career of an algo or a trader. And then we run the simulation. What does it look like? 12,000%, 55,000%, 126,000%, 53,000%, 16,000%, 14,000%. So we took $1,000 account. It took one trade a day, 250 days a year for 10 years. We turned $1,000 and we turned it into $145,000. We turned it into almost $400,000. We turned this one into $305,000. Over $500,000. $354,000. What if we had a bigger account, let's say a $10,000 account? What would that do to the numbers? I think the answer is obvious. We turned $10,000 into 10 million. We turned $10,000 into 3 million. $10,000 into 1.3 million. I think you get the idea. 1.1 million. Okay? And so what I want you to understand here is, if you take an algo like buy and sell zones and you put it on a chart and you leave it alone and you don't focus on the fact that it takes a few losses in a row. Let's have a look here. This is 2,500. How many losses did it take in a row? It took 12 losses in a row. Holy shit, that's a lot of losses. Imagine you got the algo running and it takes a loss. Who would not lose faith in their trading system after 12 consecutive losses? I think most people would. I think most people would lose faith in their trading system after that many losses in a row. But according to the maths that support this underlying concept of this probabilistic trading model, with buy and sell zone, we have an edge. We know that. And you apply it, you leave it alone, and you let it run. This is what's going to happen. 1,000 to 162 grand. 1,000 to 235 grand. 1,000 to 1.6 million. That's insane. Okay, so you don't have to win all of your trades. I wrote about this in a previous video. You don't have to win them all. Okay, but even a sample size that is smaller and with a risk reward that is very modest, we have 2, we're risking 1 and we're getting 2 out of it. That's not a lot. And if you just creep this bugger up to 41%, I think it says for 2 to 1, I think you have to be over 36%. If you win 37% of your trades, let's put it on 1,000, I think this is where it always nets positive results. Almost always. Okay? But if you're able to get this over 40%, even 43, imagine 50%, imagine you're able to win half of the trades. Just half of the trades. So you lose every other trade. You let it go. And this is risking 0.25% per trade, not 1% or 2%, just 0.25%. I mean, look at this. It's nuts. $1,000 is turned into $341,000 after 1,000 trades. It's turned into $381,000 after 1,000 trades. Okay, that's not even a year. Sorry, my bad. That's 4 years. That's insane. 534,000. 1.168 million. That's probably on the higher end, but you can see it's always positive. It's always positive when your trade parameters, your win rate relative to your risk reward are skewed to your advantage. You don't even need a lot of leverage. You don't have to take a lot of trades, one a day. Maybe you want to take, maybe you're on the hourly chart and you take way more trades. Okay, and maybe this is like an hourly, 1,000 trades. I mean, you can do that in relatively short order. And what does that look like when we have a Sharpe ratio of 5.57? That's almost unheard of. Run the simulation. 5,875. That's insane. That's insane. On the hourly chart, 1,000 trades, if you're taking a few trades a day, or a couple, or even 2 or 3 a day, I don't know, across multiple assets, I mean, then things are going to get pretty insane pretty quick. Anyway, this has been a bit of a long talk, but I just wanted to share this with you. The takeaway for the video today is that price data, despite it looking like it's well organized, is actually quite random and follows some very, very specific rules. And this rule is known as a random walk. So Google a random walk and get your head around it, understand it. Okay, and knowing that, don't you think that an algorithm with almost a random entry criteria, but a very strict risk parameters or risk management of the trades would result in something like that? I think this is possible. This is something I want to try and investigate further. Anyway, well, I'm going to leave it at that. I hope you found this interesting. I certainly find it really fascinating to talk about. But if you have any questions, please do let me know. And thank you once again for taking the time to watch this.